Hello, yeah. I see some familiar faces, but let's already get this started. And for that, let me just give you a very brief intro. Don't worry. And then from where on, I'm going to give it, of course, to our host and our guest. For those of you who don't know what DueDash is, we basically started this journey to help really the challenges that the many founders and investors face in really building qualitative relations. As you might have seen, with the current market situations, it has become quite difficult as a founder to understand how to find investors, convince them, and build a relation to actually get funding. And investors also have a lot of challenges in getting the required data and the connections they need from the founder side. We basically, as a team of serial entrepreneurs and investors, built DueDash to really ensure that that relationship can take place, and afterward, really through that, funding and further engagement is possible. If you're an investor or a startup, please join DueDash if you're not part of it yet. And of course, happy to also discuss more. I'll be in the session if you have questions also on the platform. You can write me a personal note, and happy also to share your personal link to have a further meeting. We are also supported by a large number of amazing partners. For example, also partners who offer credits and discounts, which you can get as a startup on DueDash, but also many more from VCs or incubators, accelerators to startup government entities. What I would like to do, mainly of course with startups and investors of you who joined the session, we do often like these little surveys because this helps us give you better support. And also if you're actually in need right now of any support, might it be really challenges, might you looking for further investors or how to further manage them, you can fill out this quick survey. And then also if you're interested, leave your email to get further support from our side. I will drop the link also in a second in the chat if you don't have the QR code scanner on your smartphone. So you can also just click this in a second in the chat when I share it. Yeah, and with that, I would already give it to Parul and our guest. I will highlight them just so you can see them in a second. And just if you have further questions, drop me a note. Here's also my email. And looking forward to a great session. And then let me just put you also on the view so that everybody can see you both. And yeah, then up to you, Parul.
Thank you, Michael. Thanks for that quick introduction on DueDash. Hi, everybody. Thank you for joining us today. My name is Parul Madan. I am the founder and CEO of DueDash. It's an investor relation platform that helps startups to become investable and save investors time and money. We provide standardized information and covering the entire process. And I've built multi-million-dollar companies in the past. I invest privately in companies and have been doing that for more than 15 years. Have experience in M&A and worked in corporate in the past as well. So basically the entire shebang. And I'm really excited today here to introduce Andreas from Kompas VC. Andreas is partner at Kompas. He focuses on early stage companies in prop tech, construction tech, and manufacturing, which is connected to 4.0 startup across US and Europe. He has a very, very strong background in economics. He started in his career in automotive industry, working for Volvo, which I'm very closely associated because I work for a Swedish company as well. And he went into the Volvo Cars Venture Fund there. And before joining Kompas, he was also managing director for an energy and smart city focused VC in Austria. So thank you so much for joining us today, Andreas. And I would love to know about your detours and the moments that led you to become an investor. And fundamentally, I would like to know from you why startup investing is so important for you, also as a person. And knowing your background and working in automotive industries, how did that switch happen to prop tech space? It's like a lot of detours here, a lot of interesting nuances. I would definitely like you to share all of that with us today.
Thank you, and thanks for having me. Yeah, detours is maybe the right word for everything that I have done up until now. I've studied a really long time. Actually, before I studied, I was part of the first .com bubble. Worked at the startup. Helped scaling it up from 15 people to 100 and then back to 15 again, which was mostly due to unfortunate timing because obviously our product was perfect. Then I studied, much to the delight of my parents, who always said, well, you need to do something real. And then after studying for way too long, I joined the automotive industry, as you have pointed out, originally actually in market research, but then I realized that there was a need to build an entire new strategy practice within Volvo, which I then did, forecasting sort of what would happen in the future there. Which after 6 years, I then decided I would like to get out of and do something new, which brought me into, after discussion with the board and the discussion with our C-levels, brought me into the venture investing, which I have done ever since, that I thoroughly enjoy, because I have always been driven by innovation, looking at new and fancy stuff and helping to make the world a better place overall. So given all of that, how does this come together? So when I joined the automotive industry, it was at the beginning of a major transformation, fueled by sort of increasing digitalization, connectivity, and the need to decarbonize transport. And these topics, which I usually refer to as CASE, connected, autonomous, shared, and electric, have sort of as a common theme to make the car better and to adapt it to a new reality. After having worked in automotive for a long time, I could see sort of how this was coming together, and I maybe even contributed a little bit to that. But then I also realized that there are other sectors that face the same pressures in the future, which are not moving as fast, or which don't have sort of the attention that automotive has, which led me to the smart city and electricity energy supplier route, and then actually to the built environment, because this is responsible for quite significant percentage of our global emissions, and is completely or has been completely overlooked in a lot of people's eyes. And this is where we are now working on to make the houses, the buildings that we use, and everything that leads up to sort of getting to a building, and then also recycling that building more digital and more environmentally friendly. Yeah.
Awesome. So if I may say so, you're like, I mean, I don't have a equivalent, example right now, but let's say like a Leonardo da Vinci, a bridge builder between the real estate industry and startup. Mm-hmm. And your role includes assessing the digital landscape of the industry, which is very, very traditional and old fashioned. I mean, we've been constructing houses for years that we know with different materials. And also encouraging perhaps construction industry to embrace technology to some extent. And you need to evaluate the tech solutions, software programs, the workflows that are being built that can transform this traditional and perhaps a little bit boring space to improve its scalability. So when you make those decisions on early stage investments, what kind of evidences that you look for, or the factors that you look for that demonstrate that this particular business or this particular team has the potential of success?
Okay, it differs a little bit by stage. We invest across C to Series B, and depending on the stage, we're looking for slightly different, or putting emphasis on slightly different things. When we look at the seed stage, for us, the team and the tech is the most crucial part. So having sort of an understanding of and addressable market, but having an understanding, okay, what do I need to build here in order and with whom, in order to then get to the next stage, which would be a Series A, where I would need to show traction, which I would need to show that I actually have customers. So in the early stages, we're looking sort of for a great team that has great team cohesion, but that can also fight, obviously. So you shouldn't agree all the time, because that is also not necessarily the best sign. Ideally with some diversity. that has understanding of the challenges in the industry that they want to address, have an understanding of the current business models or the underlying processes that generate value in that in the target industry, and have built sort of the first iteration of a tech product that can be tested and that has sort of initial customers. When we progress to Series A, which is a typical product market fit, we actually then would like to see, okay, yes, you have figured out how to charge for this. You have traction, and you have demonstrated or can demonstrate that the market that in the beginning you promised us is actually exists here. So that we can see, we can model that in some way. In a Series B, then we are mostly focused on sort of scaling and then the total addressable market, and a very stable, not stable, but robust revenue model underpinned by hopefully great margins.
Yeah. So at DueDash, we assess startups using our 5T model, which is team, timing, traction, technology, and time, which you're familiar with. And I mean, reviewing prop tech companies, I'm sure that technical skills are very crucial, because you want to make sure the whole system, I mean, when we build a software, okay, we are not killing people if the building falls down or something goes bad in the workflow, there could be some other kind of impact. So as an early stage prop tech investor, what kind of red flags do you kind of typically look for, whether in the team or in the business plan? What are the typical critical traits, which are important for you? And do you think that having the experience in the industry is important, or do you think somebody coming out from another industry can, I mean, you invest in the space and you come out from a different industry. What is the, let's say, the right balance, or what is the benefit or pro and con of that if you're from the industry or not from the industry? And what would be the filters that you would use to analyze a company, and also the factors that would contribute to founders' success in this particular industry?
Those are a lot of questions. Let me see and remind me if I missed one.
Sure.
Yes, technical skills are super important, but so is also an understanding of the business models underpinning all of that. You should start actually not building the perfect product, but you should, from a technical point of view, but you should build it from a customer point of view, because the customer ultimately will pay for it or not pay for it. So they are deciding. So red flags in a funding team is really sort of a major lack of either technical or business knowledge. I would hesitate funding a team sort of that does not have at least some technical ability on a C level in there. And I have seen some teams that tried sort of the 2 consultants who will hire 3 people from India to build their solution, which, yes, theoretically works, but you're missing out on quite a few things that are important for us in terms of scaling. Other red flags is sort of, unfortunately, really single founder that usually can be downgraded to an orange flag if we have the right incentive structure in place. But it usually is something where we would look for 2 or 3 founders coming together that demonstrate that they are coming together for a purpose, shared vision, that they have a similar understanding on where this company should end up, and can really work together for 10 years. And this is the important thing. A startup or company is not built within 2 or 3 years, so you need to be able at the end of the 10 years to still be constructive in your interactions and also critique each other. So in terms of personalities, we're looking not for the super genius founder necessarily, but we're looking for people who have a very clear vision and grasp and can work together with other people, because sometimes genius founders alone either burn out or just flame out overall. Then when we look sort of into whether it should be someone with industry experience or not, I'm actually pretty agnostic on that. Both have their advantages and disadvantages. So if you have 50 years of experience in managing properties and you have identified the one problem that everyone has, this is great. This can work really, really well. But it can also just replicate a process that sort of is on the way out, or that actually should be completely re-engineered. Someone is coming in from the outside, they come in with fresh eyes. They see, okay, this is something that I think doesn't work here and that needs to be re-engineered. At the same time, they maybe don't understand why this process is as dysfunctional as it is, and maybe there's a reason for some dysfunctionality that we still have. So what I would expect from either is that they demonstrate in the terms of someone with industry experience, that they demonstrate that they can be flexible in their thinking still. They don't recreate a process that they have just practiced for a long time. And in terms of new founders coming into an industry that they are not familiar with, they need to familiarize themselves with sort of the business models. How do things in general work here? And what can I actually charge for? And ideally also get some advisors from the industry to help them. I have a couple of examples from my past in automotive, which, as I said, mobility was very popular. And one of the general themes that we had is that people approached us with ideas or technology that could be put into cars, like sensors, software, and so on. And the very easy revenue model for them was, okay, we will charge you per car per year. So one euro per car per year that this technology is in there, which basically shut down any, and the whole business model was built on that, which showed then sort of the whole scaling effect and the hockey stick. And anyone working with an automotive could have told them that that is not working, because OEMs will not do that unless it's sort of a major function, like you solve all of autonomous driving. But that took quite some time for a lot of people to understand that the revenue model that they were used to, sort of SaaS or a B2B SaaS and so on, does not work in this environment. And that can often be shortened if you get an advisor who has been in the industry for a long time.
Yeah, awesome. That's like some great pieces of advices there. So for a startup, customer adoption and timing of their business when they're launching it to the market is always very, very crucial, and for their success eventually. So what are some of the growth challenges in your space do the companies face? Can you share some of the best practices for the founders to overcome those challenges for very, very early stage when they're, coming out with their product in prop tech space or even build tech space?
Sure, absolutely. And I can contrast that maybe a little bit, starting with automotive. In automotive, it's very clear you have, if you want to, within mobility or automotive, you want to get your product into something larger, then you have sort of 8-9 OEMs that make up most of the volumes that are produced globally. So your path is basically very clear. You have 8 customers that you need to win 2 of them. If 2 of them come on board, then it will become a standard and the other 8 will follow. There's a very clear path, and you need to be able or your product needs to be at a stage where you can show it to these people and where you can convince them. So you can be too early in approaching someone in automotive. In PropTech, it's slightly different. PropTech is super fragmented. So we do not have like 8 landlords globally. We have millions of landlords. We have hundreds of thousands of operators, developers, and so on, that will all have to be convinced individually, and that will also have radically different needs. So for you, in this case, you can actually or should go out as early as possible in order to learn as much as possible and drive your customer base. Your challenge in the built environment then is really the scaling, the growth, because that will require a lot more investment and a lot of more networking than in other spaces, because it's not readily accessible. It doesn't make sense to basically just do TV ads or Twitter alone, because you will lose. It's very hard to identify landlords, and you still grow building by building, and there are so many buildings that the hockey stick is very hard to do. So this is one of the challenges, and one of the solutions to this one is to make it as appealing as possible to as broad a base as possible. So really thinking from, okay, what is a common problem that everyone in this industry has, and how can I solve this with minimal overhead? Because this is probably the easiest way to scale.
Yeah, I think you said it very rightly. I recently spoke to a founder who have actually recently raised Series A in PropTech space. So they basically they came from outside the industry. So they were the users of renting properties, and they got into that space, and they were using some pieces of software, and they realized it's all broken, and they thought they're going to enter it. So they spent like 4 or 5 years just building the product, building the customer base, making sure they have a large customer base and their business model is sorted. And then they had a stable product. And after that, they basically went out for their fundraising. So I think that definitely kind of just reminded me of that story from this founder who I recently spoke to. So, I mean, as a VC, and how do you view the current startup valuations in the public market, given the recent economic downturns that we are seeing? So fundraising has slowed down a lot, and we are seeing a lot of reduction. So we have the startup funding data, which shows 39%, it takes much more time as an average duration between the funding rounds within just a period of 9 months. So can you share some insights on challenges and perhaps opportunities that can be faced by startups in this environment? And what kind of business hypotheses and revenue models do you think they should consider? Because from an investor point of view, you're looking for certain indicators like repeatable business models, certain revenues people are asking that you probably look for. Perhaps you could share some insights on that.
Okay, there are a couple of things coming together here. Number one, I think, is that we are coming off a sugar high. 2020 to 2022 was an incredible boom time within venture, fueled by LPs raising larger and larger funds, because LPs like larger funds, they come with management fees, but these funds also need to be deployed. So there was sort of I should criticize my colleagues, but there was maybe a lack of discipline sometimes in funding companies, which made it easy for startups to get funding, which is great. So we had a lot of new ideas and a lot of new startups coming into the market, and now we see now we're dealing with the aftermath. So a lot of promises and hopes were raised over the past 3 years, and now we need to weed out sort of what really is a business model that can be sustainable in an environment where we have larger or higher interest rates, we have higher inflation, and we are back basically to, let's say, 2015, 2016 in a lot of ways. So I would say not all hope is lost. So number one, great companies will continue to attract funding, and they will be able to raise with similar timeframes as they did sort of 2019, 2020, maybe even, because there's still quite a lot of money out here that needs to be deployed. In most sectors, I think some sectors are seeing more of a retraction, but in most sectors, and that money will be going to the best companies with the best traction and so on. The extension in funding rounds or longer durations between funding rounds is actually sort of also fairly healthy. Looking long term, a lot of companies 2020 to 2022 raised not because they needed the money, but because they were able to raise the money. Raising more than you need at the moment is not necessarily the best strategy, as you're diluted and your discipline in spending goes down. Also stretching yourself a little bit longer, waiting out the market is something that is not as bad as it might look on. So when you look at the rough stats overall. So we expect that most companies will probably go back to the market a little bit later than they did previously in order to, or in hopes of riding out sort of this low. But this doesn't mean that the funding side has stopped. We see overall that valuations have come down. That is a function of sort of interest rates. That is a function of the public markets, but also sort of a little bit of the fact that VCs have made themselves also a little bit scarce in the first or in the last 8 months. But overall, I think this is also returned to normal as round sizes are overall smaller now. The valuations that are fairly closely linked actually to round sizes are basically just complementing each other.
Yeah.
So what do you have? So in terms of challenges, number one, your funding round will take longer, definitely. And from the moment that you go out, you probably have sort of a date in mind by when you want to close. That will not happen. That date will go, and you will not have closed the round. And that is something, but that is something that has always happened before. Founders are super optimistic people, which they have to be, because otherwise they wouldn't do this crazy stuff of starting a startup. And they really have high expectations. As a VC, I can say I have seen only one round close on time in my entire history, and that ended, or that brought a lot of tears into the process. So don't stress yourself, plan accordingly. Don't have sort of a deadline that is 1 week before you run out of money. By the way, if you run out of money, share it with us. There's no shame in this one. Companies are constantly facing death. But if you give me a very clear deadline and saying, hey, I will run out of money in 2 months and I want to close this in a month, it has different urgency for me than you saying, well, I would like to close this in a month, and I know, okay, no, this won't close within the next 12. Okay.
Nice. I think that's very important to stress on to the founders, right? That investors also appreciate the transparency and honest, communication, because at the end of the day, they are partners on the journey. It's like what you said, not only the founding team is going to be on that journey for 10 years, but depending upon when the investors are onboarded, they're your partners on the journey. So that's very important. As a matter of fact, I have a funny anecdote to share. I was reading an article recently. I don't remember which journal was that, So it was a very well-funded startup, and they ended up raising like tons of money. Because the founder in the current economic downturn had raised so much money and they were doing well themselves, and they decided to, do some restructuring internally and make the company efficient. They thought of returning the money to the investors in this current time so that they don't have the pressure of how they're going to spend the money. And they just thought, let's just go through this phase and then go back to the fundraising round. So that was a very unique example. I just thought I'll just share that came to mind after what you said. Moving on as a next question, Andreas, I'd like to know from you personally, or even at Kompas VC, have you factored in the possibility that the startup that you're considering may need to extend their runway, maybe much more than 6 months when they're raising their upcoming round? I think you answered partially that, come back to us, but maybe how much more time do you think should they keep the runway for 9 months or 12 months? And do you also see startups are proactively cultivating those relationships with you to generate interest for their upcoming funding round?
Okay, two things here. It has always been the case that startups had to extend their runway in one way or another, and that is actually fairly standard practice. Again, that you don't need to be ashamed of or whatever. So either going back to your existing investors and saying, hey, can we do a bridge round? We think that we can get a better valuation, or we would like to hit these KPIs before we start raising the next round. Just give them sort of the lay of the land and okay, this is where we stand now, this is where we can be, and we would like to have another 6 months. Absolutely no problem. Do it as a convertible into the next round. Fairly easy. Nobody has to spend a lot of time on due diligence. That is standard practice, and this is actually, in my point of view, this is what convertibles are for. So either with your existing investors or with new investors, where you say, okay, hey, we haven't really reached sort of our targets, but we would like to get you in. Or if you have a strategic and you want to get them into your universe, then just offer them sort of like, hey, we will raise a round in a year, but we are now doing sort of a bridge round. We're doing an early A, whatever, and you can sell this. I mean, one thing that founders should be good at is selling their product, but also selling themselves and the startup. And sell it around is nothing else than selling, and you should be really good at that. Proactively cultivating relationships. You should always cultivate relationships with investors. Take them out for dinner, buy them a beer. That is always very appreciated. No, I'm joking. Please, yes, reach out to us early. Generate interest in your upcoming funding round. And it doesn't have to be upcoming. It can also be 12 months away. It can be 18 months away. It can be after sort of don't do it right after you close something, but basically a quarter after you raised. Talk to VCs. The reason why is number one, we like to invest into people that we know. Part of the due diligence process is actually getting to know you and understanding what you do and understanding the team. And the earlier you do that, the more comfortable we can get with you, and the more we understand and understand how you tick, and the more it's also we feel comfortable giving you money, because at the end of the day we are giving you money and we have to trust you with that. The other thing is that VCs are fairly busy. You might have noticed that we don't answer every email, and this is a very terrible thing that we do, but you reach out to 100 people, maybe 20 reply to you. But this is because we are busy, and we are mostly working on three things. Number one is we need to keep our investors happy, and we need to raise money for ourselves. We need to deal with the existing portfolio. and fight fires there. And then the third one is we need to do new deals, and this is generating deal flow, looking at things and closing them. That means that when we are busy, we might not immediately react. So it can take some time to get into sort of in front of a partner at a VC fund, but it can also mean that we have to turn down a deal because at one point we are doing 2 deals at the same time. We are busy in due diligence here. You would have been the perfect fit for us 2 months ago if we had known that you're raising right now, but at the moment we're going after 2 other things and we are already halfway there, so we will have to turn you down. So there's the right VC at the right time, and we need to have time and basically starting this relationship early and letting me know, hey, we will raise in 6 months, allows me to schedule, allows me to do some basic project management.
Awesome. Thank you so much for that transparent input and the inner workings of a VC world. I would like to insert a quick note here on DueDash because this is what DueDash comes in here to help startups to streamline their investor engagement and help them save time by up to 40%, because startups can share their data rooms, they can share investment memos and also updates on regular basis. You can decide the cadence, whether it's going to be monthly, quarterly, and keep yourself on top of the mind recall when you share the visualized dashboards, and you can also do one-on-one access controls. And investors and startup can also engage with direct messaging or also through the reporting functionality. And for investors, it's also a complete ecosystem, right from deal flow to portfolio management. So those of you who haven't experienced DueDash, please feel free to go ahead and set up your free profile on there. So Andreas, you mentioned about the deal flow. How do you go about, actively sourcing the deal flow for the companies that you like to invest in?
That is a good mix. We get, I would say 50% probably of our deal flow through our network, which is not very active, but in terms of how we go out, but sort of requires us to set up regular calls with friendly VCs, engage with them, and so on. That is always a great way if you have an in with one investor, or if you have a strong investor. Basically, they will start to promoting you, and that is the best way in any venture fund. So warm intros if you can get them. We use a couple of databases that from various sizes, various focus areas, read up on news. Whenever there are funding announcements, we make a mental note that we will reach out sort of after the buzz has cooled off a little bit, and make sure that we can understand the product and maybe position ourselves for the next funding round. We go to conferences quite a bit. There are different conferences, try to figure out which are the ones that are relevant for your space, and also which are the ones that the VCs are looking for deal flow at, because some conferences that we do, we basically go there from content. For some, we go there because other VCs are there, and there are startups there, but startups have a harder time to get us. And then there are conferences like Slush that are extremely valuable for our deal flow. And then we reach out actively on LinkedIn, on other pages, whenever we see something that is interesting. Mm-hmm. What I would like to discourage a little bit is the cold email. I get quite a few cold emails. Sometimes targeted, sometimes not targeted. People that have read what we're doing, sometimes they haven't. Those have a hard time. Number one, because they are fairly down in the priority list, because I have a lot of other emails that I have to deal with. Number two, it shows sort of your ability get. I'm super connected. I have 4,000 LinkedIn connections, I think. So there must be someone in my wider network that you can sort of tap in, that can say, okay, this is Andreas. I can give you an intro. Investing that time and being able to sort of like track me down or track one of my connections down and ask for an intro there shows that you have the ability to do that, to really chase other investors, but also to chase your customers. And that is sort of a soft skill demonstration that is fairly valuable.
Awesome. So in the space that you're investing in, which is prop tech, industry 4.0, and construction industry, it's a fairly vast vertical in its own way. So where do you see the potential in this vertical and the subcategories in this space that you're very excited about?
I think the most exciting at the moment is basically working with existing buildings and energy efficiency. And there's a major need to decarbonize existing buildings. And for that, there are a couple of things that we need to do. There's number one, we need to understand actually which buildings consume the most energy, or where should we invest actually in. So which buildings are fine, which need to be upgraded, and which buildings should maybe be replaced overall. And then addressing the challenges here, sort of after we have identified these, basically doing either let's say serial renovations or serial energy efficiency upgrades, helping people with the transformation from a gas powered to electricity powered energy heat source. Those I think are the ones that will be booming. You shouldn't really count on the market side and transactional side to pick up until the whole high interest rate period is subsiding a little bit. So I wouldn't count too much on that. But there are huge benefits at the moment and huge opportunities whenever you work with anything related to climate change.
Awesome. So I'll ask you some quick rapid fire questions, which I would like you to answer in short sentences. Are you ready?
Yep.
So a great 1-minute introduction that should contain all the elements when talking to an investor like yourself. Do you have an example for us?
Basically, example no.
Okay.
But components.
Okay.
So tell me about the problem and the solution that you have. So what is the problem? Why is it a big problem? What is the solution? What is the market? What is your current stage? When do you raise the next time? And that is for me the easiest at the moment. And by that I will then judge. And sorry, that sounds harsh, but that judge sort of how engaged I will be in the coming conversation. Because if you say, hey, we have this and we are closing in 2 weeks, I'm saying, yeah, this is great. I would like to connect with you after your next round. If you say, hey, we're raising in a year, then I will say, okay, yeah, let's get going with a leisurely evaluation. Yeah. And if it's within the next 4 months, then I said, okay, now tell me please all the details, everything I need to know. 1 minute is great. It can also be 2. If I can ask of something, I mentioned conferences before. So and you get these little badges, and it says investor. And when I walk across it, you might have seen at conferences people flip them over sometimes, and that is investor that actually don't want every 5 minutes or 5 steps to be approached by a startup that is not relevant for them. Do your homework, understand who you want to talk to, and approach them via a conference app, introduce yourself maybe before the conference and so on. But you have fairly low chances of, if it's a non-targeted conference, basically just approaching an investor and saying, hey, I would like money from you. So if it's a targeted conference, much better, but yeah.
Okay. So what's your take on WeWork?
My take on WeWork. I mean, some people made a lot of money out of it. Honestly, for me, it's not a prop tech. I know it is under the general prop tech, but for me, this is more fintech. So you're arbitraging opportunities. Overall, I mean, fantastic. Use them every once in a while. Use also other co-working spaces. I think we will see more of that in different ways, even more than now, as a lot of companies are really struggling with hybrid and need this flexibility.
Awesome. So some people say prop tech is the new fintech. So why do you think this vertical has a lot of potential currently?
Because a lot of things are coming together here. This is a push where you have regulation pushing the industry to change at the same time as market forces are pushing the industry to change, and at the same time as customers are becoming more demanding. So yes, I live in Berlin. In Berlin, you can basically rent out anything. So there's no need to differentiate yourself. But if you move outside of Berlin and outside of Germany, you have radically different relationships between tenants and landlords. And we see, for example, in New York and the US overall, that landlords now have to work on getting the right tenants and keeping them happy, and they invest heavily into relationships and experience platforms. So the customers are more demanding. You have market forces that push for transforming, or for the industry transforming, and you have regulation coming in. So yeah.
What are some of the latest trends in technology? How do you think the tech and data will change prop tech, and what are you watching and feel strongly about?
I think what I'm really watching is this whole, how do we heat our homes in the future? I think that is really something that is top of mind for me. We will also see some transformation, and this is not prop tech but contact, in how we build homes, because we are fairly inefficient in how we do that, and that hasn't changed for centuries, basically. I mean, the basic process hasn't changed for centuries. And personally, I would like to have a smarter home. So I have like 3 different connected device platforms that barely talk to each other, if at all. And I have way too many apps that are that I need to control things, and that is something that we also had in the automotive industry that will hopefully be solved within the next couple of years.
That's a great idea, actually. I have 5 apps for my home. Yeah. So share one of the craziest idea that was fit for you.
Craziest idea? That was on prop tech, but well, in prop tech, craziest idea at the moment is fractional ownership on Web3, but another Web3 was data storage on the blockchain, which once I started poking holes into 1 or 2 holes, it sort of all fell to the ground. That was a crazy ride. Apart from one person on a taxi ride once from Silicon Valley to, well, not from San Francisco to Silicon Valley, that was definitely crazy and should have been checked out by a therapist or psychiatrist. That was an interesting ride.
Okay. I think that happens a lot. Everybody is booming with ideas there. So yeah. So I would like you to wrap up this some outlook for this industry, because it's booming, it's a beginning, and it's being compared to fintech, like I already mentioned, and it's still in early stages. So how rapidly do you think it will mature?
Ooh, I mean, that is the big question, isn't it? I think it will take a little bit longer than everyone expects, and that is because you're changing an industry that is now in the beginning stages of understanding that they will have to change, but they don't know where to exactly necessarily, and they maybe wait for others to make the first move. So this will take some time, and if you're early, that is actually a good sign, because you still have a little bit of time to figure out stuff, and this is not a winner takes all market. So you have plenty of opportunities. At the same time, you need to be aware that you won't be a billionaire within 3 years, as in other sectors, but you get there eventually.
Awesome. We have also some angel investors in this audience today, and I do often get, like, if they want to get onto this industry space to invest in, number one, why should they? And what would be the motivating factor for them to invest in? And how can they evaluate an early stage company? If you have some quick few sentences to share on that.
Well, angels should do this because we're relying on them. They serve a vital role in this ecosystem, and they hopefully are then also properly rewarded for that. So a good VC investor values sort of what an angel brings and to the table, and why they should invest in this is basically because it will be one of the growth industries in the near future, or in the medium future. It will be something where you can actually do something meaningful, rather than having another gaming app or another thing that really doesn't contribute anything meaningful to society. You will help people to live healthier lives in buildings that are better for the environment, and make a decent return out of it, hopefully. And when evaluating this one, at an angel stage, it's really about the founders. It's about, can you trust these people to be in for the long haul? Do you have people who have the resilience to really build something that is will require blood, sweat, and tears for 5, 6, 7 years until things get somewhat easier, and who can also learn and adapt and demonstrate that. So you should have people that you can also, as an angel, that listen to you and that adapt to based on your advice.
Absolutely, that was very, very meaningful and very, very profound. What qualities do you value most in a professional relationship? Honesty.
I mean, this is very clear. Sorry. On two things are important here. I think as an investor, I'm not an expert in what you are doing, whatever startup you are, because you have spent years building the product, you have spent years analyzing it, but I have managed the investment process, and I have managed startups overall for a long time, so I have seen lots of things. Don't try to hide anything from me. We were open. I even invested in companies that had major red flags, and we sort of when we started the due diligence process, and we managed to sort of clear them out step by step, make the startup investable. But you need to be honest. because we will find it. And at one point, also when you make mistakes, just come to me. Everyone makes mistakes. This is you're actually being paid to make mistakes, because we startups should try things out, and sometimes things go wrong. Just tell me and get my help, get my advice, because that is standard protocol. The startups and founders often have sort of a tendency to trying to solve things themselves, and then actually making them worse or making them more difficult for themselves. So just approach me. There's nothing to hide usually, or nothing to be ashamed of. And also in the investment process, at one point, I know you want to manage the process, you want to keep your cards close to your chest. At one point, it actually makes sense. Just bring in the investor, let them talk to each other, let them hash out, because I have seen so many investment processes that have dragged on for a lot longer than they needed to drag on or last, just because we were playing ping pong with information. We, as investors, we do this 10 times a year, at least, around most often, more often. So we can behave professionally. We know how to do this in this process, and trust us.
What drives you when you get up in the morning?
I don't drink coffee, so I actually need motivation in the morning, and it's really that when I have a day ahead of me where we'll meet 1 or 2 exciting new companies, we'll be able to have a feeling at the end of the day that I will have contributed to meaningful change and invested in something that can make a difference. Actually, that actually gets me motivated. Other than that, my job is mostly saying no. So I'm excited whenever I can say yes to someone. Yeah,
I think that's very challenging. So what are you currently reading?
The Stolen Focus by Johan Hari, basically tackling the question why we can't focus anymore and concentrate. And we have so many things popping up all the time. VCs are particularly bad at this because we are handling so many processes at the same time. So I'm trying to regain some sanity.
I think that's something I should put on my reading list. That's definitely something we are all challenged with in today's time. So Andreas, if you were to give one piece of advice to young Andreas, I mean, you're young, but a younger Andreas, what would that advice be?
What would that advice be? I probably should have bought Bitcoin earlier and not sold it again, and bought some Apple stock. Apart from that, be true to yourself. It doesn't. You have to do this whole life thing for hopefully 70, 80 years. Don't try to be someone else just to please people. In the end, everything will turn out fine.
Okay. Awesome. So I'm going to take some of the audience questions here, and probably I think the first question was, do you only invest in prop tech? So in the intro, I mentioned prop tech, construction tech, and manufacturing for 4.0. Is there anything else you'd like to add in here, Andreas?
Well, we do a little bit of supply chain. When you look at this and the we basically look at the building in the center, look at the entire value chain coming into a building, which includes all of the manufacturing, especially SMEs that are under digitalized, are not as efficient as they could be, then managing them and recycling them. These are the main focus areas. We have some adjacent investments in terms of carbon capture or other things that we're looking at. But these are then on an individual basis.
Mm-hmm. Okay, now next set of questions are around the connections and outreach part. So one of the audience member asked that out of 4,000 LinkedIn connections, one would hardly know 40 personally. The rest of the connections avoid making introductions, and some don't even bother to reply. How do you tackle this or overcome this challenge?
I disagree with the 40 personally. Honestly, yes, there are probably 40 to 50 people that I interact with regularly. One way to do that is actually to schedule quarterly updates calls with them. That is honestly probably within the VC world, if you're relevant, then I have known these people and I can make an introduction, or they can make an introduction. I can and this, yes, I get the point from your point of view, but maybe LinkedIn was the wrong way to illustrate it. VCs overall are hyper-connected people, because that is how we generate value. You need to basically find a way into this net, or ideally you find a way into this network, and they will make introductions. Because one thinking is within VCs, I build relationships with people by introducing them to great startups, or by onboarding them on tools or whatever. So I need to prove to other VCs that I'm sort of a kid that they should play with. So when I get a great startup that I can't invest in because it's outside of our focus, I will immediately think of sort of 10 people that I can introduce them. And I can assure you there are definitely more than 40 people that I can make an introduction to. So I would say I can make an introduction to basically any major VC in Europe, on both the PropTech automotive side, mobility, that is actually how we create value. It is sort of, is it unfair that the people who have the great connections get sort of the intros? Yes and no. This is not me. This doesn't mean that only those people should get funding, but this should sort of target your work and your effort into, rather than sending out cold emails, really wait until the next conference, or approach, try to work through the network, try to get someone so that I have this warm intro, or that we get something that is more than hey, I googled your name, or I downloaded a list from PitchBook and work, or Crunchbase, and working off that.
Yeah, again, honesty kind of comes in handy in that as well. So keep it honest, and I think they will appreciate and probably respond to you. Okay, it's a cold email and you got my name from there, so fine, let me talk to you. I like you. Or not. Right. So the next question is, if you're building a moonshot, the kind of project that requires a sizable capital before the first revenues are achieved, how do you show traction? This is the type of startup that will never have small revenues, but once the revenue kicks in, will immediately jump over to the very high level.
Oh, this is really hard. You show traction on the technical side. So we have one startup in our portfolio that is fairly similar there. They are developing a fairly technical product that still can't be used other than for testing. I have had another one in my previous portfolio at Volvo, Luminar. They were developing LiDARs, and that was sort of very clearly they were burning like 5 million a month for a very long time. No traction other than the occasional sort of test unit that they sold to someone, but they could show technical progress. And they could show sort of, okay, there is a market out there. We have everyone understood there is a market. There will be sort of 1 or 2 technological leaders, and we're trying to make a bet on them. And that works. How do you show traction? So you show your technical progress, you show sort of the milestones that you have achieved, and you very clearly show sort of the milestones that you want to achieve and the time frames attached to this, and you measure against those. And you need to get sort of endorsement from the industry in some way or another. So yes, maybe your product can't be used now to generate revenues, but it can, more often than not, it can already be used. Or someone can say, yeah, this is something interesting that we would like to work with, and they do a proof of concept with you, they do some collaboration on something, but you need to sort of demonstrate somehow that at end of the day, someone will pay for that. Doesn't have to be revenues per se, but some sort of proof. And then there are people who fund these, definitely. So we have funded them before, but it's definitely harder than B2B SaaS.
Awesome. That was a great piece of advice. So it's been an amazing, informative session. It's been fun talking to you. I know you are on DueDash platform, and I'm sure a lot of founders will reach out to you. And I'm sure they have picked up the nuggets of information, advice that you have given to them, how they should reach out to you and what information is important for you. So I'm sure you'll be able to find some amazing startups on DueDash, and looking forward to your engagement there as well. And those of you who joined today, thank you so much for your time. And if you like it, please share it and give us a shout out. And yeah, it's been awesome, and looking forward to the next session. Thank you, Andreas.
Thank you, Parul.
Have a good evening.
Everyone.
Thanks. Bye-bye.